Hi everyone. Let's start with class 10 economics chapter 3, that is money and credit. Money act as an intermediate in the exchange process. It is called a medium of exchange. A person holding money can easily exchange it for any commodity or service that he or she might want. So in this chapter we are mainly discussing the advantages of money and other money related activities like the deposit or credit. We can discuss all these things in detail. Money, a current medium of exchange in the form of coins and banknotes, items or verifiable record that is generally accepted as a payment for goods and services, and repayment of debt in a particular country or social economic context, or is easily converted to such a form. The main functions of money are distinguished as a medium of exchange, a unit of account, a store of value, and sometimes a standard of deferred payment. Any item or variable record that fulfills these functions can be considered as money. Here we can see that in earlier ages, Indians used grains and cattle as money. Money in the sense, the form of exchange. Thereafter came the use of metallic coins, gold, silver, copper coins, a phase which continued well into the last century. Now, the modern forms of money includes currency, paper notes, and coins. The modern forms of money, currency, and deposits. These are closely linked to the working of modern banking system. So if we want to exchange something, we are measuring the value of that particular product with the help of money. And we are in the form of exchange, we are receiving or selling one product or services as a return of money. We are valuing that in the form of money, and we are exchanging the things and services, and we are trying to earn money. We are converting that value of one product or services into the in the form of in the value of money. So in the earlier days, we were not using the money or coin or currency. In that time, we practiced the barter system, which means exchanging the goods for goods. Money as a medium of exchange. The use of money span a very large part of our everyday life. Several transactions involving money are made in any single day. Goods are being brought and sold with the use of money. Services are being exchanged with money. Goods are also brought with a promise to pay money later. Money is sometimes paid as an advance with the promise of delivery of goods later. As the need for a medium of exchange became a necessary, different metals are used as a medium of exchange. So here we can find a number of examples or needs of money or the role of money. If you want to buy something or if you want to value something, we are using the money. So we cannot imagine a day without any transaction with the help of money. Now it became an inevitable part of our day-to-day life. If we want to buy anything, we need currency or money in the form of paper note or coin. That made our life very easy. It was not like this in earlier time. In that time, or in early days, we exchanged the things for things, or we exchanged the services for other services. That type of system, that is called the barter system, the problem of double coincidence of wants. This problem arises in barter system. It means that it means what the seller is wish to sell exactly match with what the buyer desires to buy. But it is very difficult to find such a person every time. Money has solved this problem. According to the barter system, we are exchanging things for things. If we want to sell one particular product, just imagine that I am a cobbler and I want to sell the shoe and I want to purchase some wheat. Then I want to find out such a person, a farmer who need to sell the wheat and who want to buy a shoe or something or any leather product which I have or which I need to sell. So it is very difficult in every time to find out such a suitable person. The problem of double coincidence of ones. In the olden days, when modern currency was not in work or in use, people had to sell and buy each other commodities. This was called the barter system. For instance, if a manufacturer wants to buy the wheat, he has to find a farmer who wants to buy his shoe in exchange for the wheat. Both parties have to agree to sell and buy each other's commodity. This is known as double coincidence of wants. In a barter system where goods are directly exchanged without the use of money, double coincidence of wants is an essential feature. Barter system. A barter system is an old method of exchange. A system had been used for centuries and long before was invented. People exchanged services and goods for other services and goods in return. So that is called the barter system. We are exchanging services or goods for other services and other goods. So it was very difficult to find such a person or to sell something and buy our appropriate or desired product. In earlier time, we used the wheat or cattle or sugar or the salt as a medium of exchange, not like the present day or the modern day currency, but that a form or the normal everybody needs such things, the cattle or the salt. So they used such things as a medium of exchange the long before when we started to use this modern currency or coin or money. In early ages, Indians used grains and cattle as money. Thereafter came, came the use of metallic coin, gold, silver, copper, and perhaps continued well into the last centuries. So in at present, in the modern time, we are using different coins or different forms of money for exchange the things that made our life very easy. Currency. The modern form of money is included currency, including paper notes and coins. The modern currency is without its own use. In India, the Reserve Bank of India issues currency notes on behalf of the central government. In India, rupee widely accepted as a medium of exchange. It is accepted as a medium of exchange because the currency is authorized by the government of India or government of our country. No other individuals or organizations is allowed to issue currency. Here, we all know that the Reserve Bank of India, RBI, they used to issue the Indian notes or currency. It is their prime duty to issue the currency. No other individual or organization or authority is not supposed to issue the notes or currency. The modern form of currency is not have any other use by its own. Just before we discussed in earlier days, the people used the cattle grains as a form of money. It had its own use, the cattle or grains, it had its own use. But the modern paper currency or coin, they don't have any kind of its own use. By utilizing that paper currency or the coin, we cannot do anything else. The only value or only the use of such currency or note or coin is to exchange or buy something. It don't have or they don't have its own use. Different countries, different currencies. We all know that almost all the country are having its own different currencies. The main countries and their currencies: USA, dollar; Britain, pound; Canada, Canadian dollar; Singapore, Singapore dollar; Japan, Japanese yen; Australia, Australian dollar; Sri Lanka, Sri Lankan rupee; China, China's yuan. So these are the some examples of different currency which is used by some famous countries or important countries in the world. The next we need to discuss about the deposit money in bank. The people needs only some currency for their day-to-day needs. People deposit the extra money with the with banks by opening the bank accounts in their name. Banks accept the deposit and also pay an interest rate on the deposit. In this way, people's money is safe with the bank and it earns an interest. People is have the provision to withdraw the money as and when they require. Since the deposit is in the bank account can be withdrawn on demand. These deposits are called demand deposits. The other forms in which the people hold money is as deposit with the bank. People deposit their extra cash with the banks by opening a bank account in their name. bank accept the deposit and also pay a amount as interest on the deposit. The deposit in the bank accounts can be withdrawn on demand. These deposits are called demand deposits, which means if we have the extra money or extra wealth, we can deposit that money in bank account. We can create our own bank accounts and we can deposit that money in our bank account. As a return, the bank will give some interest on that. Then we can earn something more other than our saving. We will get or we can earn something more. Then if you need that money, if we have the balance in our bank account, anytime we can withdraw according to our demand, our need, we can withdraw the money. So such deposits are called demand deposit. According to our demand, we can utilize our money or we can withdraw our money. That is called demand deposits. The payments are made by check instead of cash. A check is a paper instructing the bank to pay a specific amount from the person's account to person in whose name is check has been issued. A deposit in a bank of a deposit in the bank offices are the customers the facility of issuing checks. A check is a paper instructing the bank to pay a specific amount from the person's bank account to the person in whose name the check have been made. The recipient of the check can deposit it in his own account in his bank. The money is transferred from one bank to another bank account in a couple of days. The transaction is complete without any payment of cash. This is a safe mode of transforming the money, avoiding the possibility of theft. So if we have the extra deposit or the bank account in the bank, instead of using the currency, we can use a promissory note or check instead of the money. To whom we need to pay the money, on his name we can make a check. Here we can see one image of the check. I think we are familiar. Most of us have our own bank account and checkbook. Here, to whom we need to pay the money, we need to type or we need to write their name and specify the proper amount, which how much we need to pay. Then the person, he can withdraw the money from our account and he can, if he need, he can deposit that money on his own bank account. Nowadays we can transfer the money from any bank to any other bank. In the recent time we can find a number of changes or growth in the form of the banking system, just like the mobile banking, ATM, the Google Pay or something like that. The banking system now it became so liberal. The role of RBI, Reserve Bank of India, issuing the currency notes is one of the main important or main role of Reserve Bank. So instead of the central government, it is the duty of the Reserve Bank of India to issue the notes. The second role, that is banker to government. So we can say that the central government, all the economic activities in the central government, which is controlled by the RBI, Reserve Bank of India. So we can say that the banker to the government. The third point, bankers bank come supervisor. All the banks in India, they should register under the Reserve Bank of India, and they want to maintain a fixed amount as a safety or deposit in Reserve Bank of India, and they used to supervise all the activities which is done by other banks. So we can say that the RBI, Reserve Bank of India, is a bankers bank and as well as a supervisor to other bank. The monetary regulations and management, the interest rate of any loan or the credit, all such money matters when controlled or decided by or monitored by Reserve Bank of India. Exchange management and control, collection of data and publication. So regarding the money or money related matters, all details or data were collected by the Reserve Bank of India and they used to publish. So these are the main role or functions of Reserve Bank of India. At present, Shashikanta Das is the present Indian Reserve Bank Governor. Shashikanta Das. The next important point which we need to cover, that is loan activities of bank. The banks keep only a small portion of their deposit as cash with themselves. These days, banks in India hold about 15% of their deposit as cash. This is kept as a provision to pay the depositors who might come to withdraw money for their bank on any given day. Banks use the major portion of their deposit to extend loans. There is a huge demand for loans for various economic activities. Banks exchange a higher interest rate on loan and then what they offer on deposit. The difference between what is charged from the borrower and what is paid to the depositor is their main source of income for banks. A loan is the lending of money from an individual, organization, or entity to another individual, organization, or entity. A loan is a debt provided by an entity, organization, or individual to another entity at an interest rate. The evidence evidenced by a promissory note, which specifies, among other things, the principal amount of money borrowed, the interest rate and lender is charging, and the date of repayment. A loan entails the reallocation of the subject assets for a period of time between the lender and the borrower. So this is an agreement. We need to, if you required money or financial assistance, we can take the money from the bank as a loan. As a return, we need to pay a little more amount as an interest. But if you want to get the loan, we should give some kind of promissory note or we need to give some kind of evidence to the security. Then we need to follow the rules and regulations that will vary from the one bank to another. The most of the banks, they are interested or they are ready to assign loan to the person. So they used to take the deposit from the people, and they are, by utilizing that money, they are extending the loan to the others. They are charging or they are giving less interest rate to the deposit, and they are charging more from the loan. So that is the difference between what they are charging or what they are giving to the deposit and what they are charging from the loan or the borrower. That is the main income of that particular bank. So nowadays we can find or we can take different type of loans from the bank: the vehicle loan, the property loan, personal loan, business loan. So something like that, we can find different type of loans. Loan activities of bank. The banks keep a small portion of their deposit as cash with themselves to pay the deposit who might come to withdraw money from the bank on any given day. Banks use the major portion of the deposit to extend loan. In this way, banks mediate between those who have surplus fund, the depositor, those who are in need of these funds, the borrower. Banks charge higher interest rate on loans than what they offer to deposits. The difference between what is charged from the borrower and what is paid to the deposit is their main source of income. Coupon accepted successfully. So here, the credit or loan activities of bank. In our textbook, we can see two examples of the credit system, the two different credit situations. The credit or loan refers to an agreement in which the lender supplies the borrower with money, goods, or services in return for the promise of future payments. Here we can find two examples which help us to understand how credit works. The first one is the festival season. In this case, Salim obtained credit to meet the working capital needs to production. The credit helped him to meet the ongoing expenses of production, complete production on time, and thereby increase his earnings. In this situation, credit helps to increase the earnings, and thereby the person is better off than before. The second case, Sopna's problem, the credit for the crop production. The Sopna's problem. In Sopna's case, the failure of crops made the loan repayment impossible. She had to sell a part of her land to repay the loan. The credit instead of helping Sopna improve her earning, left her worse off. This is an example for debt trap. The credit in this case pushes the borrower into a situation from which recovery is very painful. Whether the credit would be useful or not, depending on the risk in the situation and where there is some support in case of loss. So in the first case, we can see that person, Salim, he utilized the loan, or he taken the loan for improving his financial status. But in the case of Swapna, she was not able to she was not able to repay the loan, and she was, or due to the crop failure, she was not able to repay the loan on time, and she was forced to sell a part of his land to repay the loan. So that is a example for the debt trap. So if you are not able to repay the loan on time, the interest rate will increase. Then that loan, the help from the bank, it will become a debt, or it will become a burden in our future. Next, collateral, the terms of credit. Every loan agreement specifies an interest rate which the borrower must pay to the lender, along with the repayment of the principal. In addition, lender also demand collateral or security against loans. Collateral or security is an asset that the borrower owns, such as land, building, vehicle, livestock, deposit with banks, and use this as a guarantee to the lender until the loan is repaid. If the borrower failed to repay the loan, the lender have the right to sell the asset or collateral to obtain payment. In addition to the interest, lender may demand the collateral or security. That means if we need to take a loan from the bank, we need to submit some kind of collateral records or security records, which may be the evidence or the proof of our owns, the borrower's owns, such as land records, building or vehicle, livestock, deposit in the bank, etc. Then they will get a surety. That means we are able to repay the money on time. Then if the borrower failed to repay the money on time, then they have the right to sell the borrower's the collateral or security to obtain their money. Interest rate, collateral, and documentation requirements, and the mode of replacement together is called the terms of credit. It may be vary depending on the nature of the lender and the borrower. So the whole process, the interest rate of a loan, the collateral, which type of document we are submitting, the documentation requirements, and the mode of repayment. This all together is called the terms of credit. It may be vary from one bank to another. The next is the formal sectors in India. Here we can find the three examples. The cheap and affordable credit is crucial for the country's development. The various type of loans can be grouped as formal sector loans and informal sector loans. The formal sector loans. These are the loans from bank and cooperatives. The Reserve Bank of India supervises the functioning of the sources of loan. The banks have to submit information to the Reserve Bank of India on how much they are lending, to whom, at what interest rate, etc. But at the same time, in the informal sector loan, the informal sector are the loan from money lenders, traders, employees, relatives, and friends, etc. These are, there is no organization which supervises the credit activity of lenders in the informal sector. There is no one to stop them from using unfair means to get their money back. The formal and informal credit. The formal the formal sector means only about half of the total credit needs of rural people. The remaining credit needs are met in the informal sources. It is important that the formal credit is distributed more equally to that the poor can benefit from the cheap loans. It is necessary that the banks and the cooperatives increase their lending, particularly in the rural areas, so that the depending on the informal sources of credit reduce. While the formal sector's loan needs to extend, it also necessary that everyone receives these loans. The working of the cooperatives and the people take loan from cooperatives. Besides banks, the other major source of cheap credit in the rural areas is the cooperative societies or the cooperatives. The members of a cooperative pool their resources for cooperation in certain areas. There are several types of cooperatives, namely the farmers cooperatives, weavers cooperatives, industries workers cooperatives, and so on. The example of the Krishak cooperative. Krishak cooperative functions in the village not very far away from Sonpur. It has nearly 2,300 farmers as members. Every day or weekly or monthly they will gather and they will fix a amount and they will deposit or they will collect money from the members, and from that they can give loan to the members. In this case they can determine or they can decide the interest rate or other credit procedures. Normally in cooperatives they will work or they will give a lot of services to the people. That means all the members or the cooperative members, they are having some kind of hold in that, or they have some kind of share in that cooperative. The cooperatives accept a deposit from its members. Using the deposit as collateral, the cooperative obtain a large loan from the bank. The loan amount received from the bank is used as a fund to provide a loan to the members. Once the members repay the loan, the amount is repaid to the bank and a fresh loan is taken from the bank. The cooperative provides loan to its members for purchase agricultural implements, loans for cultivation and agriculture trade, fisheries loan for construction of houses, and for a variety of other expenses. In cooperatives, the cooperative members, they used to deposit a minimum amount in the bank, and by showing that bank account, they can, or the bank will give a loan to this cooperative. By utilizing that money, the cooperative members, they can take the loan at a small interest rate. Then they can improve in the case of any agriculture cooperative, in order to improve their earnings or in order to improve their production, they can take the loan to buy new machineries, or for fertilizers, or fertilizing the land, or to improve the technical support. They can utilize that money. And here, if you are taking the loan from the cooperatives, that is, the interest rate may be little less as we compare to other private, the informal sector, or in the bank. Here we will get little more relaxation, or the less interest rate, or some kind of subsidies. So in the rural area, these cooperatives, they are working nicely, or the people are ready to take, or they are interested to take loan from these cooperatives. Next one is self-help group, SHG. Self-help group for the poor. The poor householders are still depend on informal sources of credit because of the following reason. The banks are not present everywhere in the rural India. Even if the bank are present, getting a loan from the bank is much more difficult, as it requires the proper documents and the collateral. To overcome these problems, people create self-help group, SHGs. Self-help groups are small group of poor people which promote small savings among their members. A typical self-help group have 15 to 20 members, usually belonging to one neighborhood, who meet and save regularly. The main advantages of self-help groups are it helps borrowers to overcome the problems of lack of collateral. If a poor person, if he may not have the collateral or security documents, even though he can take a loan if he is a member of a self-help group, if he has some kind of deposit or savings in the self-help group, he can take the loan from that particular self-help group. Next, the people can get timely loan for a variety of purposes and at a reasonable interest rate. As we compare with the bank loan, here the loan procedure is very easy, simple. If there is any emergency, at that time we can take the loan from the self-help group at a reasonable interest rate, less interest rate. The third point, the self-help groups are the building blocks of organization that the rural poor. So in every nook and corner of India, we can find like these self-help groups of the rural people. But in the rural India, it is very difficult to find the banks. Banks are not present everywhere in the rural India, but every nook and corner of India, we can find the self-help groups. The fourth point, it helps women to become financially self-reliant. Nowadays, the women's self-help groups, that the numbers are increasing. It helps the woman to become independent, financially self-reliant. The fifth point, the regular meeting of the group provides a platform to discuss and act on a variety of social issues such as health, nutrition, domestic violence, etc. So here, then self-help group, the people in that neighborhood or locality, they will come together and they will share their problems. If they face any kind of problems which may be related to health, nutrition, domestic violence, or whatever may be, they will share their problems in commonly and they can find out a solution. So these are the main advantages of self-help groups. Nowadays, the women, they used to participate or they used to actively participate in the self-help groups that helps them to become financially fit or financially self-reliant. Grameen Bank of Bangladesh. Grameen Bank of Bangladesh is one of the biggest source of the success story in reaching the poor to meet their credit needs at reasonable rate. Started in 1970s as a small project, now has over 6 million borrowers in about 40,000 villages spread across Bangladesh. Almost all the borrowers and women are belonging to the poorest sections of the society. These borrowers have provided that not only the poor women reliable borrowers, but that they can start and run a variety of small income generating activities successfully. Professor Muhammad Yunus was the founder of Grameen Bank and recipient of a 2006 Nobel Prize for Peace. So, the Professor Muhammad Yunus is the founder of the concept of Grameen Bank. So that is just like the self-help group that mainly the women they used to participate and they can take the loan or they need to deposit something, they need to save something, and by utilizing that saving as a the security, they can take the loan from the group Grameen Bank. So the concept started in 1970. Now it flourished, has now has over 6 million borrowers in about 40,000 villages spread across the Bangladesh. So he is the Muhammad Yunus. Muhammad Yunus, the first Nobel Prize winner from Bangladesh, the founder of Grameen Rural Bank in 1976. So the next point which we need to cover, that is debt trap. What is debt trap? It is a situation in which a person taken a loan and due to unavoidable circumstances he is not able to repay his loan. Now face a difficult situation and has to take a tough decision. Either he has to borrow a fresh loan or sell some of his property to repay the earlier loan. I think from our textbook there we discussed the Swapna's case. She taken the loan in order to improve his agriculture, to improve his cultivation. But due to some problem, she was not able to repay the loan on time. In that situation, in order to repay the loan, she was compelled by the circumstances to sell a portion of his land or property in order to repay that loan. That is called the debt trap. If you are not able to sell or if you are not able to repay the loan on time, we will lose our existing saving, or collateral, or security. That is called debt trap. Chit funds. Chit funds means a set for the collection of small savings of the people who earn a daily basic, like chaiwala or panwala, etc. These people can save rupees 10 and rupees 100 on a daily basis and deposit in the fund. The money collected in invested in the share or de- denominated debentures debentures of the companies or in the government bond to return earned on these investment paid back the investor after deducting the administrative charges of managing the fund. Here, the chaiwala, the common people, they can invest the different amount according to their capacity, 10 to 100 rupees per day. And after collecting this amount, they are investing that money in the share market or in some other area. Then from that amount, if that profit, at last they will get the depositors, they can benefit it from that. The plan your future wisely, save our money. Plastic money. Nowadays, we are utilizing, or we are, instead of using the coin or paper currency, we are using the plastic currency, which means the debit and credit card. That is called the plastic currency. Other than this, nowadays we are utilizing the mobile, that is the Google Pay or RuPay, something like that. Mobile transaction is very common at this time. Thank you.